Hello everyone, welcome to my channel Commerce Simplified. So this is the finance syllabus of RBI Grade B. This is Module A, Financial System, and these are the chapters, 7 chapters. This is Module B, Financial Markets. This is Module C, General Topics. These are the chapters, 7 chapters here, and in the next page 2 more chapters, so total of 9 chapters. This is Module D, Reports, 3 reports. Then this is the first chapter of Module A, which is Structure and Functions of Financial Institutions. So what is the role of financial institutions? Financial institutions are organizations that facilitate the flow of funds from surplus units to deficit units. Who are usually the surplus units? Households. They generally have surplus money after their expenses. They have surplus money which they either save or invest. There are deficit units like businesses who need capital to run their business or to expand their business. To bridge the gap between the surplus units and deficit units, there are financial intermediaries involved. And these financial intermediaries, they are the financial institutions which facilitate the flow of funds from surplus units to deficit units. This is the main function of financial institutions. They can be broadly divided into these 3 categories: regulatory bodies, banking institutions, non-banking institutions. Regulatory bodies, the main or the most important regulatory bodies are RBI, Reserve Bank of India, the central bank of our country; SEBI, the Securities Exchange Board of India, the stock market regulator of our country; IRDA, regulator and supervisor of the insurance sector; PFRDA, which is the Pension Fund Regulatory and Development Authority. It manages the pension funds in India like the NPS and the APY. Then banking institutions, there are scheduled commercial banks, there are cooperative banks, we will read more about it later, and there are non-banking institutions which are the NBFCs. There is a difference between banks and NBFCs. NBFCs don't accept demand deposits. What are demand deposits? Savings account and current account. The deposits which can be repayable on demand are called demand deposits. NBFCs, because they don't accept demand deposits, they cannot issue checkbooks also. They are not part of the payment and settlement systems. That's why this is how they differ from banking institutions. For banking institutions, their main function is accepting deposits for the purpose of lending or investment. Next, these are the regulatory bodies which I just mentioned: RBI, SEBI, IRDA, PFRDA. In the upcoming videos, we will study in detail about like RBI, about SEBI, IRDA, PFRDA. More detailed version of RBI and its functions, and in brief about the functions of SEBI, IRDA and PFRDA. Now, coming to banking institutions. First, scheduled commercial banks. They are included in second schedule of RBI Act 1934. In this act, in the second schedule, the name of these banks are written. Okay. These comprises of public sector banks, private banks, regional rural banks, foreign banks, small finance banks, payment banks. At present, there are 12 public sector banks in India, including the SBI. Private banks, owned by majority stake is owned by private players. Regional rural banks to facilitate the rural economy. Foreign banks established outside India but operates in India. Small finance bank and payment banks are also called as differentiated banks. These two banks are new age banks which have recently come up. Their committee was formed, Nachiket More Committee, Usha Thorat Committee. After that, these two banks were introduced and licenses were given. These are the new age banks, also known as differentiated banks. Next, cooperative banks. What are cooperative banks? Cooperative banks are the banks which operate from mutual cooperation between its members. Members come together and they deposit money, they lend money for the mutual benefit of their members. There are urban cooperative banks, there are rural cooperative banks, there are also district cooperative banks. In the upcoming videos, we will read about this in detail. Right now, I am just giving you a brief outline, just the basic, the outline, okay. Cooperative banks are dually regulated and supervised by RBI and Registrar of Cooperative Banks, okay. Dual supervision and regulation. Next, differentiated banks, which I just mentioned, small finance banks, payment banks. Small finance banks, they were mainly set up to help the small industries, okay, small industries, micro industries, small and medium enterprises. Payment banks, they are the digital form of banks, like they don't have branch like presence. They accept deposits digitally, okay. Now coming to non-banks, which is the non-banking financial companies. What are their main features? They don't accept demand deposits. They are not part of payment and settlement system. They cannot issue checkbooks. They do not have access to DICGC facility, which is provided by banks. DICGC facility is the insurance facility of deposits, like deposits up to rupees 5 lakh in a particular bank, the account holder is insured. DICGC provides this insurance. So thank you. So this was just a brief outline. In the upcoming videos, we will cover all of these in detail. Thank you.